George of the jungle, strong as he can be.
Okay, folks, welcome back to thecreditjungle.com today. We're going to go and dive into these numbers just a little bit on this concept of sell your mortgage, and to really show the benefit not only to the seller but also to the buyer for somebody who has a low fixed rate interest rate on their mortgage loan and they're contemplating selling their home, and being able to use this to generate 5, maybe even 10% more money for your home and still have that be a benefit to the buyer but also a tax-free benefit to the seller. So these are the numbers from the chart that we pulled up in the first couple of videos there, and this just shows here basically this first one here. We're using somebody that doesn't have perfect credit, but anyway, at the pricing at the time, 7.25%, 5% down, loan amount is $600,000, principal and interest payment $4,093 a month. This cost to buy down, we're just going to call it par. It's a little less than 1%. But the difference here of being able to get down to the next lower rate, there is about a 3% cost here and then an additional 5% cost here to get from 1% here is 3%, another 1% there costs 5%. Nobody's going to be paying, this. You might be able to get 3% in concessions from the seller, but then the buyer still has their closing costs to come up with because these are discount points in addition to the lender fees, title fees, and appraisal on it. It's just not there. But anyway, what is the benefit then to a buyer who's looking at this? Because first of all, you got to sit and ask yourself, well, why would a buyer be willing to pay more than market price for the house? Well, the reason is because they don't really want to pay this. $4,093 a month sounds like a lot more money than $3,313 a month. That's a $780 per month savings to be able to go on there. So you're just kind of like, well, as a seller, it's like, well, if I could lower your payment by maybe $500 a month, would you be interested in still buying my house if we could take your payment down? And the buyer would be like, yeah, great, how does that work? Okay, this again involves doing a seller finance contract, and there's a lot of different ways to put these together. We've talked about it in other videos. Everybody has a case-by-case situation that is going to be unique to you. So this is not something that I'm going to paint with a broad brush and say this type of contract is what you use, because it's custom. It's something that you can customize, and that's the beauty of a seller finance contract. But if that buyer can say, well, wait a minute, you're telling me that I could have maybe a $3,500 or $3,600 principal and interest payment, and I could even pay more for your house? Okay, well, great. Tell me how that works. So even if they wanted to get down to this is a $400 per month difference on here. So let's just say that the seller wanted to offer their home and offer seller financing at 5.5%. Well, that's going to be a savings of somewhere in between here, but let's just go here and show what we've got for a delta here. This one going from here down to here is, not going to do it with that one. Let's try another one. This one's going to be about $400 per month. This one's going to be $780 per month, okay? Again, we're looking at this, not right now. We're not looking at this from the seller standpoint, but we're looking at this, why would the buyer be willing to pay more money to buy your house? We're going to get into these numbers in the next video after this. Thanks for coming into thecreditjungle.com today. We'll be right back.